My guy was supposed to share the screen with you. Did he do it?
He's ready. I can go. I can do it now.
Okay. Why don't you go for it?
Okay. I'm Phil Singleton. I'm with Pacific Advisors. I help people plan for financial security and also wealth accumulation and wealth distribution strategies. Some of you young guys like Jacob, probably a good idea to take some notes. Some of these older guys probably need to think about some of the things that I'm going to talk about because most people who are in my industry don't talk about the things that I talk about because they're pretty standard. Let me share my screen with you and we'll get off to the races here. I been doing this for, I've been in the industry for 24 years. I've been 20 years with the firm that I'm with. And the reason I've been with this firm so long is because we have concepts that other people just don't do. This is what I've noticed over the years. This tool that you're seeing on the screen is a tool that I use for all my clients. It's called the living balance sheet. The living balance sheet is unique to our firm. And the reason they call it living, because it updates every day. It's tied into every financial institution. So someone can see where they're at any given time. But it also is a place where we can talk about different concepts and narratives that help people plan for different ideas. So today we're going to talk about wealth distribution and a strategy for that. And typically, if you're a traditional financial advisors do something what's called the 4% rule for retirement. How many of you have ever heard of that? The 4% rule. Can I see your hands? 4% rule is something that was devised by a traditional financial services company where people are supposed to live off 4% of their money after they get there for the rest of their lives. But what's interesting about that concept, and I'm going to touch on it a little bit, is that it's never really worked. So it's hate to bust your bubble, but here's what usually happens with people who try that particular rule.
The 4% rule basically states that retirees can withdraw that much from their portfolio each year without depleting the principal too early. For decades, many advisors favored this tried and true method with little challenge until recently. Retirement planning experts from Morningstar have released a paper that argues that these days, retirees cannot withdraw 4% of their portfolios and expect them to last 30 years. They say the reason is the stark difference in interest rates. In recent years, interest rates have been far below historical averages. Therefore, mathematical assumptions based on historical figures will be wrong. The experts also say portfolios heavily invested in bonds provide lower returns during their first few years, slowing the portfolio's growth. In later years, the portfolio will have less money available for distribution, and it will run out of funds sooner. Since living on withdrawal rates of 3% or less is unappealing to most retirees, they should consider alternatives. One is to work beyond the age they plan to retire to bulk up their savings. Or they can invest more aggressively and hope higher returns will make up for the shortfall. If all else fails, they can learn to live on less. The best option for most is to reallocate into more aggressive assets. But retirees should be careful to limit their risk. Preferred stocks, mutual funds, and exchange-traded funds that invest in bonds are instruments that provide income with only moderate risk.
So what happens is that all these people are trying to do things to win the money game, but they don't usually know what it actually takes for things to work. And our firm does things so much differently that we have to take what we call a holistic approach to financial decision making, so that what we want to do is make something that's going to work all the time. And there are ways to do that, is people just don't know about it. So if you have during the 4% rule and you're already on this process, you may have less income than you want, might have to pay more taxes than you need to. Most of your money's at market risk. Like when the market goes down, people are trying to hold your hand, say, stay in, but it may not be a good idea. The other thing that happens is since interest rates went up high, the bond prices dropped. So there are people who lost 10, 20, 30, 40% of their portfolio because they had so much money in bonds because it was quote unquote safe that they're losing money. And they also have less liquidity. So this is a problem for people. So what we do at our firm is a little bit different. We look at everything that's happening in the two parts of your life. Basically, there's two parts of it: your wealth accumulation phase and your wealth distribution phase. And if you address all these key issues, I'm going to talk about 5 of them really quick. And hopefully, if you don't have or you're dealing with this stuff, if you can deal with it, then you'll be better off financially. So this is more of an educational type of thing, and I'm not talking about any particular product. So during your accumulation phase, obviously you have to talk about mortality. Obviously, if you die too soon, it could be a problem. But in the distribution phase of your life, what happens if you live too long and you run out of money? So that still needs to be addressed. The next part is sickness or illness. In your accumulation phase of your life, if you're working and you get too sick or hurt to go to work, that might be a problem if it hasn't been addressed. But also in the distribution phase of your life, what happens if you start getting ill and you spend all of your money trying to stay alive? So that might be a process that needs to be looked at. The next thing that I want to talk about is this: market volatility. You guys have all seen market volatility, but in your accumulation phase, a lot of financial advisors will use the terminology like dollar cost averaging. Anyone here heard of dollar cost averaging? Okay, what's the opposite of dollar cost averaging during your distribution phase? Has anyone ever talked to you about that? Well, I'm going to talk about it briefly. Here's something called sequence of returns. Let's just say, for illustration purposes only, that someone starts their nest egg and they're trying to live off 4% of it because that's what they were told to do from their financial advisor. And so 4% of $2 million is $80,000. So they're living off $80,000. And the person, their financial advisor, puts them in a portfolio: stocks, bonds, mutual funds, ETFs, you name it. And supposedly they're supposed to get they'll show you the historical thing, because no one knows what's going to happen in the future, but they'll show you historical average of, say, 8%. So your advisor says, look, I'm putting you in this portfolio. It averaged 8% rate of return. You should be happily ever after if you live off 4%. So you sign the contract. They're putting in the portfolio, and in your mind, 8% is what's going to happen. So this is what people expect in their mind their life's going to be like for the next 30 years. They're giving themselves a 4% raise every year to offset inflation. Their money is growing at 8%, so their money is growing over time. So this is what people assume is going to happen for their life. La, 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 as they say. But in reality, the market is somewhat unpredictable. In fact, it is. No one knows what ever is going to happen. But what happens, I'm going to hit this random button. What happens if your portfolio started off like last year and you had minus 10%, then it went up 26%, and it's down 4%, up 20%, and then 22%. This is looking at 10-year average for 30 years. But if you look at this 10-year average, even though it's going up and down, your financial advisor says, look, you're getting 8% average. You're fine. But in reality, because how sequence of event hit your money as you're spending it down, it doesn't look quite like that in reality. This is actually what's happening. So instead, this particular example, instead of having someone having $5.3 million at the end of their 30-year run, they actually have 2 million. Now you're probably thinking, hey, 2 million is not bad. My advisor says I still have a 10-year average of 8%, which is not telling you a lie. He's telling you the truth. But what happens if it happened like it did in 2007 and 2008? I'm going to hit the worst button here. It's down for many years, then it goes up, but this average is still 10-year average is 8%. And you're thinking, great, fine, same scenario, 10-year average 8%. This particular scenario, because it was down so much in the beginning, this person can actually run out of money just because of those sequences of events. Now, I've been doing this for all this time, and I very rarely if any, hear a financial advisor talk about this particular scenario. They always talk about other things, but they don't talk about this. And this could actually happen because the market never goes up high enough over time for it to last that particular time. If it's down for, particularly in the beginning part of when someone gets to their retirement point. I have people that I've got as new clients, and they decided to retire in 2020, right when the market was doing this hit. Now it's going back a little bit now, but that stuff, depending on their age, it may be unrecoverable. It may not last them for 30 years of their life because they're not dealing with this issue of sequence of events. And I'm just curious, has anyone ever had their financial professional tell them about this particular story that I just said? Nobody? Isn't that amazing? I think it's pretty amazing because it happens all the time and no one wants to talk about it. But I talked about mortality, illness, and injury. And I just talked about the market volatility and how the sequence of events can hurt people during the distribution phase. Now, there's two other issues that I haven't even dealt with, but let's talk about them. Tax differences. If you're living off your 4% and the capital gains tax changes, that's going to hurt your distribution phase also. Are you guys aware that the Trump tax cuts are set to expire? If Congress does nothing, it's going to expire. So if someone's in their retirement stage and they're living off their capital gains from their investment portfolio, if they don't renew that, it really depends on what's going to happen in Congress. If they don't renew that, the capital gains is going to go up. Every retiree that's living off their interest rate is going to be hurt by that. And the way they structured it in our government, that it has to be voted on to keep it intact, or else it will expire and the capital gains rate is going to go up higher. So there's another things that make you go, So here's the next thing, inflation. Now, before, nobody was talking about inflation prior to recently, and now everybody knows what's happening. I mean, you go to a fast food restaurant right now and it costs more than it does to go to a high-end restaurant. That's totally amazing to me. But everyone knows that inflation is at play. So all these things need to be dealt with to retire happily ever after. And that's what we do. We help people look at the big picture of everything that's going on and deal with all these issues so that you have a way to figure out or to stop that. And I'll show you one of the ways we can help that. First of all, you have to protect your money where you can, but protection things that are in place. We help monitor cash flow. That's why this tool that I have, Living Balance Sheet, is so important, because we can see exactly what's happening, what's the decisions that people can make on a regular basis. The next part is maintaining some true liquidity, not having all your money in your advisor's portfolio that supposedly that they're working with. You have to break it up in a lot of different places. And then lastly here, put money in places where you can have tax efficiency in your portfolio. So if you deal with all this stuff, you can get a more predictable, better outcome. And having a balanced structure, as opposed to putting all your money in one big account and just hoping and praying that your advisor knows how to break things up. You can break that up and have some stuff in some guaranteed income sources. There's nothing wrong with having a portion of your portfolio in a guaranteed fixed product, like certain types of annuities. The other thing is have some things that are variable that will go up. So you have to have a lot of different things at play to make things work out in the long haul if we're looking at more than 10 years. That way you have some better concepts or ideas. So that's my presentation for today. I hope you guys learned something. Our process, I do some data gathering, do a protection analysis and cash flow analysis, and then we implement and review a plan on a regular basis. So that's what we do at Pacific Advisors. Anybody have any questions? Go ahead, Boshi.
You've spoken a lot about stocks and bonds and so forth, and I'm not going to dispute it at all. I happen to agree with you. Although I do question when the bonds have dropped in value. As part of the plan that I have two questions. As part of the plan that you're working with people regarding distribution, are the bonds being sold as part of it, or are they living off the interest on the bonds? So, because if they're living off the interest in the bonds and the bond drop in value will not affect them much because when the bonds mature, they get the full value of the bond at that point.
It
That's my
depends.
first question.
If they're just living off the bonds, when interest rates go up, the bond value
No, I know that
goes
it's
down.
it's an inverse relationship. I understand that.
Right.
But the
So
point is,
you
if they're
want to
not,
have a
if the,
mixture. You want to have a mixture of things, not just one thing. The
no,
people that are all heavy in one thing all the time are the people that are going to get hurt.
I agree with you that, and I do know that. My point is, if you're living off the interest of the bonds as opposed to the value of the bonds, then you won't be affected by the drop in the value of the bonds because when the bonds mature, you get the full amount of the bond back.
That's true.
So that's why I'm mentioning it. My other question was, which you didn't mention, and I'm going through this now with my wife's retirement. Unfortunately, I didn't have a choice of who she used. Otherwise, you would have gotten a call. But the people are using, which is part of from the family. One of the things we did, we put some of her money into commodities such as oil and so forth, because we thought that might be a hedge against inflation to use commodities such as oil and gold as a way to help diversify her portfolio to go with the inflation aspect. What do you think about that as part of more like a fund, not her going into buying
Yeah, I think that's brilliant. The problem isn't not it's not that any idea is good or bad. It's just that they should be doing everything. I
okay.
had a meeting last week with the top person from State Street, which is the largest ETF company in the United States, and they hired a guy that was at one of the other companies, and this is probably the smartest person I ever met in my whole life. He was probably about 42 years old, and he'd been in the industry since he's one of the I recommend all concepts. So what if I don't get paid as much money on because I'm not handling gold? I don't. But if that's what they need as part of their portfolio, 5%, they should be doing that. If they should be doing real estate, they should be doing everything. They just shouldn't just do one thing and act like it's the end all save all, because that's where people get in the most problems.
So are you focused on mostly index funds or are you using mutual funds? Because there's a lot of
Use everything.
there's a pro and con on the expense side of the mutual fund versus index funds and other types of
That's
funds.
that's a myth. Okay.
Really?
Here's the thing. When people manage a portfolio, they're going to charge a fee. So if you do index funds like ETFs, the fee that's in there may be like, say it's 1% or 1.5%, depending on the size of the portfolio, they're going to charge a fee. The fee is going to be there, good or bad or indifferent. There's certain mutual funds, if you do it commissionable, or you could charge a fee too. There's ways you could do both. It really depends on. I always try to make it the least expensive ways for my client is the way that I want to go. That way I can't come back. Someone can't come back later on and say, "Hey, dude, you're jacking me on price." I don't have to worry about that because I'd rather take the smallest fee possible and call it a day. That way, they're my client for a long time. That's just the way I look at it. So
So what
you get break points when you sell mutual funds, right? So if you have a larger quantity, the price is down. It could be less than the fee that you're charging. People don't realize that. It's not always 3, 4, 5%. It could be 0.5%, just depending on the quantity that they're buying. And,
may I also
and a
add one
lot
more
of times
fact?
people don't show people the fees, so they don't know what's happening all the time. I'm transparent in fees. That way, people can see what they're paying for and why they're paying for it.
Well, the reason I'm asking that is, I had an advisor I'm paying the advisor 0.08%.
Mm-hmm.
All the advisor had me in is all mutual funds. So I'm not
That's
really
because he's
saving a
not
lot.
creative.
I'm not saving a lot of money in that scenario. Now I fired the advisor, but I didn't really realize that because the mutual fund's a mutual fund. But when you start adding in that expense, you start in, and then if any of them have B12B1 fees, and then you have the advisor fee, that guy's making money no matter what. Of course,
That's
it's
my point.
based on performance, but the performance is, oh yeah, if it's a down year, we don't get paid as much. Well, that didn't work out because the bond market crashed, like you'd mentioned. So I take the hickey on the bond market, but the advisor still got paid what they got paid for the balance of the portfolio. So then I got to wait for the recovery time. So that's why I'm bringing this up, because there's a lot
Well,
of different
here's the thing.
views.
Advisors, they advertise stuff on TV and they think that's the end all. Oh, I'm just charging a fee. I'm not taking commission.
That's why I'm bringing it
You
up.
could have
People don't
saved your
realize
money
that.
on the commission part, but and still have the same thing. Because when someone sells a mutual fund, you could take all the fees out of it, like sell them R shares or C shares. Not They don't always have to be A shares, B shares, or C shares. There's different when
But
you
even
integrate with
if they're not, there's still this, even if they're if the I shares, institutional shares, et cetera, there's still a fee in it on top of
then
the
they're built into the
advisor
fee.
fee. And then you're just waiving trading fees with the advisor
Right.
fee. So,
Mm-hmm.
but I'll just
Wait,
bring up, okay, an index fund that's more selective and a bond ladder that's more structured, those tend to going to have a lower cost if you're not paying for any trading fees, correct or not?
No, you're always paying. Anytime something moves somewhere, there's a fee. Someone's getting paid. Anytime something moves something. So if you do an ETF exchange rated funds, you're maybe giving up something internally on the cost side, but he's still making a management fee to manage that ETF, and that 8% is not gonna go away. You see what I'm saying? The
Well,
point
if they're
08%.
putting in that fund that has that higher expense, yeah. So that's why I'm getting at. You have to kind of be educated yourself on, well, okay, what's the expense on this, whether it's an index fund or whatever, that I'm paying on top of the advisor fee.
Right. And people
Anyways,
don't realize that because they don't know why they're doing what they're doing. Because people say, "So I just want you to charge a fee." Well, we can charge a fee, or we can not charge. I show people, here's what the cost for fees. Here's a not for a fee. Here's what you're trying to accomplish. What do you think is best for you?
right. But the less fee you have, the better and you get a return, and the better the portfolio is going to perform, et cetera. It's the fees that also eat into, even though they're small, they still eat into everything over a period of time. And if you have a
Right.
correction, then that
Right.
still eats into your further. And then it takes that much longer to recover from the correction. So
Or
you
if
get
you may
10%
never
loss, like you
recover if you're
mentioned.
older. If I have people who are in their 70s and they're not healthy. If it dropped because they made a bad decision, it's not going to recover in their lifetime. I mean, think about that. I mean, all that stuff's at play. So you have to have balance
Well,
and structure in what you're doing.
well, I agree. But I also think people also need to, you go bankrupt. Everybody with these health issues, they're going bankrupt because of what's going on with the pharmaceutical industry and the hospital organizations and just healthcare in general. Nobody's even putting that mathematical issue, because you need to allow for that. Like, what is
Oh,
your
that's
insurance
what
going to be?
I
Oh, I
mentioned
do.
that in my thing. I mentioned it. That's why I talk about that. I make sure that they plan specifically for the health thing. Either there's two things are going to happen. If you're healthy, if you're skinny right now, I'm talking about skinny people, and you don't have any health
Just so
issues.
you know, skinny doesn't make any difference.
I'm just saying, if you're not a smoker and you don't have diabetes, you're probably going to live long than someone who doesn't. But everyone in here, 1 out of 2 people are going to need long-term care at some point in the future. It's either going to be a slow burn, or it's going to cost you a whole bunch of money up front. Something is going to happen. Nobody's getting out of here alive, but so
Right.
you'd have to plan accordingly and make sure that set aside's there. Or I mean,
But if you have a
most of my clients
catastrophic
get a reverse
event,
mortgage, and I
then,
don't even sell reverse mortgages because
I'm
they
just
need
saying
that
that
money for healthcare.
I'm just saying, if you have a catastrophic event, it changes the whole picture of everything on your financial strategy. Heart attack, a stroke, you're debilitated, that really hammers it, because now all your costs go to those issues. So
And you have
anyways,
that.
I'm
And
gonna shut up.
the worst case scenario is Alzheimer's, because it's like lingers. You can have a brain issue and you're lingering for 14, 15, 16, 17 years way down the road. And that's eating up cash flow that would be there. So
And that's why
planning for
people
this
should,
is
that's why people
strategic.
should get tested for it, because they have a test to see if you have the genes. That's one way to determine it too. But
Or you could just smoke cigarettes and eat the way you want and call it a day, because you're gonna make it.
well, that's what people a lot well take tobacco out of it. If you just keep eating processed food and fast food, you're going to have a long history of going to the doctor in and out because of all the damage you're doing, and people just need to wake up. It's just bad.
Yeah.
I mean, just look around. It's just bad.
I totally get it. So anyway, it's
By the
better
way,
to
I just
know
want
than not know, than be surprised and go, oh crap.
That's why I
but
suggest people have lab work done. Now you know. Okay, we caught the problem. So
Mhm.
by the way, Justice Sandra Day O'Connor just died, and came out that I think for the last 5 years of her life she had dementia. So no matter how brilliant people are, you're not immune from, unfortunately, from that disease. And President Reagan had it for close to 10 years before he died, something like that. At least, if not 10, at least 8. So it can linger.
Well, at least that most people who are doing what I do are just managing a portfolio and they don't care about outcome. I'm the outcome guy.
No, so
Live your
I
life the way
understand.
you're supposed to be. So I'm gonna, if we can plan ahead and look, through the looking glass and try to figure out the best way to do it. That's the way I think that's best for my clients.
Let me just throw in the reverse mortgage since you broached it. One of the advantages of having a reverse mortgage is the fact that if you end up needing nursing care, it won't pay for them to put a lien on the property, because the way they set it up is they put out, at the time of the initial reverse mortgage, 1.5 times the amount that the house is worth. And by doing that, nursing homes even if they want to put a lien on the house, they're going to end up not getting much, if anything at all, as a result. And that's one of the advantages of the reverse mortgage as a
Reverse
strategy.
mortgage is probably the best thing that people can do if you couldn't qualify for long-term care insurance or had the financial ability to pay for long-term care insurance. The thing about long-term care insurance, even though I do sell that, sometimes it's not cost effective, because the way the insurance companies design it, they're allowed to change the cost of it even after you've instituted and put into effect. They can come back later on and say, hey, we priced this wrong, we're going to charge you more. And if your cash flow is not allowing that change, you're either going to have to take the decrease in benefit or walk away from it. Whereas a reverse mortgage, when that's in effect, it's a regulated product, so it's guaranteed to go up over time. So you always have the money that's going to be growing over time, regardless of what the house does as far as the value goes. People don't realize that that's a guaranteed product.
Yes and no. On a reverse mortgage, I was involved with them. So I was involved when they first came out under government rules, not the original ones in the 80s. But with reverse mortgage, depending upon whether it's an FHA related reverse mortgage versus a Fannie Mae related reverse mortgage, there are differences. In a FHA related reverse mortgage, if the house is worth less than the amount owed, depending upon which program, I'm not going to go into the weeds, depending upon which program you choose, the estate does not have to make up the difference. Whereas in the Fannie Mae one, they can go after the estate for the difference if the value of the house doesn't meet the amount actually owed.
Well, just think,
So
if you needed the money for health purposes, guess
Mhm.
what? You can't sell the house because it's too late. If you have the reverse mortgage, you already have cash. You could write a check against
no,
that today.
no,
It's a way better
again,
product.
I was involved in it, and I believed in the concept. So no, you're preaching, at least in my case, you're preaching to the choir.
So, Jacob, you have no excuses. Now I gave you information. So you're young enough to
Absolutely.
do it the right thing now, so you don't have to do it. And
Yeah,
you talk to Armin over there and be healthy and call it a day. Then you don't have to worry about any of this, Chris.
absolutely. Yeah, no, I'm an athlete, so definitely I'm still actually playing 4 times a week. Got to stay fit. That's really the number one thing for longevity. And then with, more financial wise, I actually am working with financial advisor who is my company owner's cousin. He's kind of helped me get started into separating some between stocks and bonds. as well as into an IUL policy, but I, can plan on furthering my education to have a better understanding and
I
get
kind
more
of lean
diversified.
against the IULs because sometimes it eats up the
Really?
cost inside the cost of the
Yeah,
insurance.
people don't understand how you.
Okay.
Oh,
Yeah, I mean, it looks good because what happens is they falsely
the cost of
illustrate
insurance
things
goes
that's
up.
not real.
Mhm.
The cost of insurance goes up in the product. It's not a good product. So I'm just,
Yeah,
that's my
Okay.
whereas traditional whole life products,
Okay.
it's guaranteed. It's not based on the market. So you're going to get it based on particularly with mutual companies, you get a guaranteed growth on it. So that's something that most people in the insurance industry who are licensed don't even know the difference between the different types of products.
Mhm.
And that's very important to know why you're doing what you're doing. And when someone gives you an illustration, it may not be real. They'll illustrate 12% rate of return and it actually is -3. What are you going to do?
Mhm.
well,
So
Megan,
understanding the
thing you
difference
gotta
between the
understand
different
is the
companies
cost.
is
I'm just saying the cost of insurance goes up in those products. It's not a fixed cost of insurance.
no, that's only in IULs and VULs, not in whole life products.
Yeah. No, that's what he was mentioning because I mentioned IUL, so he's saying that price can vary. It's
And
not a
it's at
Not
the
gonna go
whim
up at
of the
all right
insurance
now.
company.
Yeah, it's not gonna
Pardon
go
me?
up right now, John.
No, an IUL, the insurance company has the right to change the internal cost of the insurance because it's built on a term chassis. People don't realize that. So
Okay.
every year the cost of the insurance goes up built into that product. For whole life products, the cost is flat and steady and will
Right.
never go up because it's guaranteed to stay at a certain price.
Okay.
Yeah, you're gonna be better off
And
with a mutual
people who are
company
selling
on
it
that.
pretty much will never tell
Okay.
you that because they probably don't know that.
And people
Mhm.
don't.
May I
It's
go back
true.
to, may I
I
go
came
back
in
to
a
what you,
weird way, so I have a little weird background as far as um, I I have a science background. I have a zoology and chemistry degree. So
Oh wow.
my understanding on how money works, I came in a different way. So I wasn't just taking things as face value. I test everything, and someone has to tell me why something's happened. If they can't explain why, then I'm a problem with that.
may I go back to something you
I
said
like that.
before? You talked about in-care insurance that sometimes it gets too expensive. To give you an idea of how that industry has changed, you have fewer companies even in it. You had General
Oh yeah,
Electric that
they
was
all
in it.
left because
They've got,
they
they've all,
falsely
Mr.
undersold
Buffett
the
just talked
product.
about the fact that it doesn't give the kind of returns now that it used to, that it's not worth it to be in that. I think there's only two countries. I think the two companies, Genworth is still doing it, but they changed the terms. But there's only about 2 or 3 companies doing it now, where there used to be about 3 or 4 times as many companies in that industry. So it just shows you how it's diminished,
Well,
both
the
in terms
bigger
of coverage and
problem,
return.
the reason for that is because it had a low lapse ratio. If the lapse ratio was going to be high like they predicted, that's how they priced it. But when people, had it like, I'm going to hang on to this because I'm going to probably need it. So then they started scrambling, the claims started coming in. They just priced it too cheap to get market share.
Yeah, that's exactly
That's it.
what they did.
That's it
They came
exactly.
in
Yeah.
they lowballed it to get people in, and then they didn't care what was going to happen on the outcome.
And then they
The
just like,
worst thing that
hey,
happened to
we're
me
not
is
gonna
when
write
the
anymore.
clients
We're not
come in and
going to
have
issue anything. Yeah.
people will call me and go, "Hey Phil, I have this old product that I didn't sell it to them a long time ago," and they show me everything that they have, and they go, "Should I keep it?" And I look at their analysis. Sometimes it's a good idea to keep it. Sometimes it's not. You just don't know.
It depends on the liquidity of the company, would be my opinion. Like I have Northwestern Mutual for my long-term care, and they price it right from the beginning, but they were always higher than everybody else. But they
Mhm.
don't raise they haven't raised the rates at all. I do have an extra buy up to and continue to increase the daily limit. But anyways, I think you're gonna be better for a mutual company in that kind of situation because you're an owner in the company.
Anytime you get insurance, it's typically better for a mutual company if you're looking at longevity and outcome.
Yeah.
Because the cost is owned by the people who own the policies as opposed to a stockholder who's they're beholden to the stockholders for other companies.
Which
Of
is what
course,
made
Jacob, no one's ever going to tell you that, but we're going to tell you the truth.
Prudential such a successful company through the years, because they're owned by their policyholders.
Well,
Well,
no, not
Prudential, they
Prudential.
became a stock company, so that
Yeah,
all.
it
No,
became
no,
a stock company.
I'm not referring to the stock. I'm referring to the Prudential insurance for decades. I'm not referring to the stock, to the change that they made when they took over Beige, or however you pronounce it. Bah.
So there's only 4 big mutual companies that people should work with. There's Mass Mutual,
Mhm.
there's the Guardian,
Mhm.
and there's New York Life and Northwest Mutual. Any
Yeah.
other ones is probably going to jack you around at some point in the future.
I agree. But they're also financially secure. I mean, they're very powerful companies. They have
Yeah,
really
they're A plus rated
Right.
companies
yeah.
to deal
That's
with.
what you want to look for if you're going to do insurance products, anyways.
And New York Life's been around for over 100 years. I think Mass
All
Mutual's
of
been
those
around
four
for about
companies
80
have been
years.
around well over 100 years.
Right.
150 for most of them.
Yep, or 160,
Yeah.
right around there for a little
Gee,
while.
that takes him down. That takes him to the time of the Civil War.
That's
Oh,
right.
yeah.
Somewhere before that.
Well, you know how the mutual companies got created? Do you know how they were created?
Yes, they were. Originally, you remember Company Emeritus?
Well, no, what I'm saying is how the whole concept of insurance was created for a mutual company. So I'm just going to say it because, maybe people maybe they know, maybe they don't. But basically, farmers had to protect themselves so they wouldn't lose their land to the bank. So they got together, put money in case one of the farmers died, would pay off the mortgage. So they just kind of grew from there. So everybody, if there was excess money, then everybody got a dividend back based on what they paid in that year. And that's how the companies grew. But they also got really smart on how to reinvest their money. And that's how it all evolved. So that's how the mutual companies thrived for the longest time. And when they started becoming stock companies, that's when everything went awry.
And the other thing is they were using mutual companies to prop up banking system also.
Yeah.
And they still do that to this day. The largest owner of mutual company death benefits are owned by the top 4 banks in the US. It's called bank-owned life insurance, and they put it on the executives of a bank to build up their infrastructure for value. Because the only thing better than a whole life product is gold, as far as over time, as far as how things are paid and balanced out,
Mhm.
which is
I'm
pretty
glad you
interesting
brought
in
that
and
up.
of itself.
What is your company's view about dipping maybe 0.5% of your portfolio into cryptocurrency? Especially
If I
since it's
talk
now
about it,
becoming
I'll
part of
go to
hedges.
jail.
Okay, never mind. I mean, I'm referring
No,
to legitimate. I'm referring to it's now a legitimate conversation. So I didn't expect you to possibly be a member of Club Fed. But is there any talk about that now? The fact that crypto is becoming more acceptable in use.
probably.
Okay,
There's nothing wrong with having a little piece of it in your portfolio. I think
I said 0.5%. Please don't think I'm trying. I just was wondering if there's any discussion about that. It's or even that
Here's
amount.
what happened. Check this out. There's a guy in our company who's been in the company 30 years. And his client kept bugging him. Tell me about crypto. Tell me about crypto. Because I can't, because we can't allow to talk about it because of our securities license. We're not allowed to bring it up. And this guy finally said, do you have any? And the guy said, yeah, I have some. And then he said, well, what are you doing? So he told him what he did. Crypto market tanked out. The guy called the company. Our guy got terminated
Really?
next day for just telling him what he did for himself.
Client asked him.
Oh, pardon me?
I said after the client asked him about it and said, "What are you doing for yourself?" He got turned. That's unbelievable.
That's how people
We're
are,
under
man. When it comes
the
to money,
Security and Exchange
all bets
Commission.
are off.
The Security and Exchange Commission doesn't play.
But it can't. I mean, it's just too much of a problem.
Yeah, but they're now allowing it. You now have a crypto hedge fund. In fact, people like Anthony's I can't pronounce it now. Scaramucci has had a fund through Bridge Capital, whatever it's called. So you're starting to see it being used more and more in legitimate purposes. So that's why I asked, are you allowed to see? You're still not allowed to talk about crypto?
I'm not going to comment.
Okay, fine. So are you allowed to talk about marijuana companies? They're trading in Canada?
Can't talk about that either.
Okay, I was wondering what
Had someone come to my office and wanted me to put insurance on their marijuana company. They have $5 million sitting there in a warehouse. And I wrote the letter up. What's our thing on marijuana companies, blah, blah, blah. I got the email. No, we're not there yet.
Where Jones has that policy, even though it's legitimate in certain states and they're operating in certain states, they will not discuss marijuana or anything related to that industry because it's not federally approved.
Correct. So I don't plan on being a statistic, so not going to happen.
I wasn't trying to make you a statistic. I was asking what the parameters were.
Yeah. Phil was talking about crypto and marijuana. He's out.
Yeah, it's being recorded. Oh no.
I have no
All right,
comment.
gang. We're coming to a close. We only got like 6 minutes left. Anything other than what we were talking about, have any worth mentioning? Nothing.
So we're all good.
We're all good. All right. Well, rather than, holding people on, I think what we might do is call it quits a few minutes early. Is that okay with everybody?
Bob, I'm going to see you tomorrow for your function.
Yes, absolutely.
All right, fine.
Hey,
Phil,
Armin, you and I need
thank
to
you
talk.
thank you
have
so
way
much
too
for your
knowledge
presentation
over
today.
there for a health guy.
Thank you so much for your presentation today.
Yeah, it was
Well,
great.
I was in the business for a while. That's why I bring it up.
Did you work with Northwest Mutual?
Northwestern, yeah.
Yeah, Northwestern. Okay. I figured. They have
I
good
like
products,
it.
all except for one. Their disability product sucks, but everything else is good.
I've had my
What's
New
that?
York life policy since I was 19 years old, and like you heard, I just turned 75 today. I've had it so long, and it's always played a great dividend. I've had it so long, even my agent passed away. So,
Well, it's a cash value policy, so it probably has a good amount of it's a cash value policy that has a good amount of cash in it. So,
yeah, right.
So you have some living benefits with it too. It just depends on how you want to use it.
So true.
So why'd you leave the industry?
Because it sucks, man. I hear all the pain you're going through. I mean, all these, every time you got to go through compliance, they find something on a piece of paper. You didn't get this signed. It wasn't initialed properly. And,
Everything's all electronic, so it makes things so much easier. I don't
yeah,
have
well,
to.
now it is, but I've been out for a while, but it was just, I went in 2004, everything got deregulated. So I just was going to sell insurance products. And then next thing you know, well, you got to do investment products because everybody's competing on that. And it just got out of control. And then you have all the expenses of running an office. I'm like, I was in for like 6 years. I'm like, I'm out of here. It's I did well with what I did. But it's like I just got so sick of it, so it's changed
I can
now.
see how people at Northwestern had a rough time because they're kind of archaic in is their philosophy.
Oh, they're
So
very archaic, man. It's like you have to find your own business.
So the background of our company is the Guardian, and all they're into is creativity and new things. So that's why, like that living balance sheet thing I showed you, that's a Guardian product.
Yeah. Well, I wrote some stuff with Guardian. They're a good company. I mean, you can write Guardian, but you can't write Northwestern Mutual unless you're a Northwestern Mutual rep. So then that's
Right.
just
So that's why they're most.
that's
Do
a
you know
can
that
of
most
worms.
of the people from the Guardian are former Northwest Mutual people?
Yeah, they get fed up with the way things work.
Yeah.
Anyway, that. People don't really care to hear about all this, but
They're all got anyway. All right. Well, you guys have a good one.
good talking to you, man.
All right.
You too. Thanks again.
Interesting meeting.
All right.
All I
Yes,
got.
it has been.